Good morning, everyone. Good afternoon, Alf. Hold
Hi,
on.
George. Hi,
Hey, good to
George.
see you. So, real privilege to have Alf with us today. We've spoken. We met in Michael Guyad's space a couple months ago. Become a huge fan. Great minds think alike, as they say. I think we have a very similar worldview, so I don't want to turn this into an echo chamber, but to the contrary, I think yours is a very important voice that needs to be heard. Many people are just not, they didn't get the plot, they didn't get the storybook, and so I think you have a very differentiated point of view, which has been it's quite useful. It's been quite correct. It also happily coincides with my own view of the world. Before we get into a conversation, just it's been a week since we last did a space. We had a great space a week ago, last Thursday, with James Ferguson. Gave a terrific tour de force of the world and his view that inflation's not going to go away, that rates going to have to go a lot higher. Talking his book, talking my book, leaves him with a very negative view on risk assets, as is the case for myself, and Alpha is the same. Although how we get there might be a little bit different. Just a couple quick comments, as we haven't done a space in over a week. We had a couple days of good market action end of last week, and right away people get all excited and game on again. So you're saying there's a chance. I think, as I keep saying, it's a fool's errand to try to figure out the gyrations on a a daily or weekly basis. As John Roque, one of the best chartists on the street out there, has put out that chart, and I keep retweeting it. The fact that counter trend rallies are a feature, not a bug of a bear market. It's just enough to keep people sucked in. To remind everyone, in the 2002 NASDAQ bust, when NASDAQ fell 78%, 47% of the trading days the market was actually up. There were 15 counter trend rallies over 10%, 10 counter trend rallies of over 15%. So, I suck at short term trading. I'll just tell you that right now. I get all these nasty tweets from people. Oh, gee, how's your, Tesla short working out for you? Your Coinbase short working out for you? I mean, some of us have been short Coinbase for the last 75% down. So nice try, guys. The bottom line is, I think this is only the end of the beginning. I think we have a long way to go still. I don't want to get too overly bared up. I want this to be an open conversation with Alf. But bottom line is, I'm still very negative on risk assets. I'll go into some of my deeper views a little bit later on. But we're really here to listen to Alf. Alf is well known to those who are paying close attention to it in FinTwit. He's been really a voice of clarity and reason and consideration. He's been right. It's not just been right, but he's been right for the right reasons. And his methodology and his point of view, how he gets those conclusions, I'm a huge fan of. And so for me, it's a real pleasure that Alpha's been so kind to spend 45 minutes with us this morning or this afternoon to share his views. So, Alf, welcome. Good to catch up with you. For those that didn't get a chance to listen, Alf did a podcast with Wealthion, which was posted just in the last few days. There's two segments to it, and it's quite useful. If we don't get to cover all the material here today, I urge everyone to go look at those Wealthion interviews. But I really want to make this interactive as well, so I'm going to shut up and let's just get at it, Alf. So, Alf, you've been so right. You've been right for the right reasons, as I say. For those people, though, let's try to put ourselves in the position of the average person at home who, is looking at this. Whereas before we had the everything bull market, now we have the everything bear market, and it's like, oh, it has to stop going down, doesn't it? I mean, shouldn't we be buying? And where do you think we are in your framework, either in terms of time or price? How far along do you think we are in this whole thing? Do you think, obviously, it all gets crucially to the central banks and the Fed and inflation and having to break things and tighten financial conditions. So either in terms of price or time, they always say give people time or price, never give them both. But Could you just give context to sort of your overall thought process and how much further you think this has to run in terms of time or price? Thank you, Alf.
Thanks, George, for the very kind introduction. It's a pleasure to have such an endorsement, especially coming from you. I always say that two things. First is I don't know exactly what's going to happen, and I never assign a 100% probability to any outcome. I don't have a crystal ball. By managing money, I understood that I need to assign probabilities and look at facts and look at models and make up an hypothesis. And if I'm wrong, I need to stop out. That's the very first thing I want to come across. I'm never always right or wrong. What the other thing I want to come across with is instead of setting up the stage for why I have a certain view, I would rather come and present my top two trades at the moment that are sitting on my book. Because managing money and talking to all the investment banks and strategists out there, one of the first questions in every meeting that I always ask them was, what are your positions? What shall I buy? What shall I sell? Because that tells you a lot about what people really think rather than some macro blubbering they can do for an hour without telling you anything. So instead of doing the macro blubbering for an hour, I'm going to start.
Alf. I mean, we don't get to bullshit each other for an hour about what the Fed's going to do and R star and swaptions 12 years forward correlate to the sunspots and the moon. I'm so glad you said that, Alf. There's so many what I call macro bullshitters. That's all they talk about, and then you're done listening to them. Their lips are moving. They talk a lot, but they say nothing. So thank you for that, Alf. Thank you. Let's just go straight to the trades.
Yes.
How are you trying to make money, and what do you think investors listening to this call, what should they be looking at? Thank you.
Yeah, welcome, George. So I have two books. One is a medium to long-term book, and the other one is a more levered, tactical, long-short global macro book for nimbler investors, let's say. So if you're a nimbler investor, my top two positions right now are short the S&P 500 and short BTP, which are Italian government bond, against long bunds, which are German government bonds. So I'm basically betting on the spread between Italian government bonds and German government bonds to widen, and I am short the S&P 500. Those are the top two positions. So basically short equities, short credits. That's it on a nimbler version. If you're not that nimble, you don't want to do futures, you don't want to do options, you don't want to do leverage, and you're a long-term, let's say long-only investor, then I don't have a lot of good news for you, I'm afraid. The only thing I would suggest is, as this is the cycle where you really don't want to take risks, this is the cycle where to play defense, not to play offense. Raising a healthy cash allocation is actually the best thing I can think of. And stay the farther away you can stay from valuation intensive, highly speculative, non-cash flow producing companies. This is actually the easiest recipe I can come on the table. So if you can be short, then do be short, because I think, answering your first question, George, I don't think investors are appreciating the extent of the reaction function the central banks have to prove to markets they're willing to put on the table to slay the inflation dragon. It's not nearly being priced, and we can discuss where do I see the distribution of probabilities going, and because of that, then I also think the valuation repricing we have seen so far is a healthy one, but there is more to go, and the PE actually hasn't really moved on the E front, on the earnings front, which is another thing we need to consider here when we talk about risk assets.
Alf, I have to laugh. You use the word healthy correction. Don't you love when people say, "Oh, it's a healthy correction"? Like, I don't remember ever gone through a situation where I've lost money and been glad because it was a healthy correction, as opposed to an unhealthy correction. Okay, so no, but I completely agree. I'm teasing you. I'm teasing you.
Fair enough.
Yeah. So Alf, let's, instead of the blah blah blah, I'm going to go straight for the throat, because you're a sharp guy. We're on the same page. We can go directly. I'm going to go for the throat on this one. Let's go for the knockout punch. So I'm gonna sort of let my hair down and confide my innermost deepest fears. I've talked about this on and off in the spaces that I've had, and I hesitate to say it because, if it turns out to be the market's only down 20 or 25%, it doesn't go down 60%, people can say, "Oh, you're wrong." And historically, it's always a fool's errand to predict a crash. I'm not predicting a crash, but I would say a few things. One, markets only really ever crash from oversold conditions. Whatever oversold means, and we can get to that later. So you have, I would say, the necessary but not sufficient conditions for a crash. You have, as you said, risk assets have come down in price, but they're not cheap. Liquidity, my fear is that people are going to be surprised how much. So I guess I'll start with an easy question for you. One of my underwriting fears is that people may be surprised how much rates have to go up, how much tightening is going to be necessary to get inflation down. People are confusing growth with inflation. They're synonymous, but the correlations shift a lot. Depends where you are. So go back to the past decade of the Great Moderation, where you had relatively more robust growth, but yet low inflation, for all the reasons we know: Eurasian savings glut, productivity, globalization, blah blah blah. Now we got the movie running in reverse. So now, yeah, we get growth slowing, but you don't get the commensurate decline in inflation, or at least the sufficient decline in inflation that the central banks want to deliver. And so that they may have to really tighten hard, especially because some of the factors here are beyond their control, their supply side. So last I checked, the Fed can't grow more wheat, the Fed can't grow for more oil. We got globalization going the wrong way, commodity price, et cetera, oil, et cetera, et cetera, et cetera. So my question to you is, I guess the first question is, what's the chance that rates really have to go up considerably more than people imagine? I mean, you had people already a few months ago, just turn the clock back a few months ago. Well, they can't raise rates because as soon as they raise rates, the economy's, things are going to break and blah, 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 blah. I mean, those are the same people who were saying it was transitory. So I just completely ignore them. So I guess my question to you is, I'm on a rant here. That's why people listen to my nonsense. What's the chance that rates have to go up considerably higher? No, let's just take the U.S. 10 years as an example. All right. It's remarkable. It's remarkable that the 10 years gone from 175 to 293, having been 320 to 325 not that long ago, has gone from 175 to 293. And, that's against the backdrop of equities selling off pretty hard. And you may say, well, that's the reason equities did sell off pretty hard. But if I told you in yesteryear and kinder times and bull markets, if I said to you, hey, you know, ARK is going to go down 70%, NASDAQ's going to go down 25%, the S&P is going to fall 15%. What do you think bond yields are going to do? You'd say they go down. No. And this speaks to the change in correlation between stocks and bonds. So I guess the question is, I'm sorry to blather on so much, but I'm trying to get as much context in the question as possible. What's the chance that people are going to be shocked how high rates have to go in order to give us the sufficient slowdown to deliver not slower growth, but deliver lower inflation? In other words, is a 4% 10-year beyond the realm of possibility?
So, George, to answer this question, which basically is what I have tried to do looking at Europe in today's piece on the Macro Compass. It's my free newsletter. It's going to come out in an hour. So if you subscribe now, you can get the piece in your inbox for free in about an hour. I looked at exactly this question. And every time I structure a trade, I always have to think, what is the market pricing in, right? Because this is a game of probabilities, George. You don't need to be right or wrong. By definition, you need to anticipate how the market's going to shift its probability distribution. If you're earlier than the market in that shift, then you make money. And it doesn't really matter at the end if terminally you were right or wrong. So let's examine your question. It's a very smart one. Can I do it from the European standpoint,
yes, please.
George?
Do it for the European one, and then we'll modify it for the U.S. one. Go ahead.
Yeah, I love it. So, okay, European standpoint. Let's see. Tighter monetary policy is not an absolute definition. Tighter means tighter than neutral, tighter than an indicative rate that doesn't make the economy overheat or cool down. So in the US, we have heard the Federal Reserve tell us multiple times that this nominal neutral rate is somewhere between 2.5% and let's say 2.5%. That's what they say, right? It's unobservable. There are some models. Let's say it's 2.5%. Now, the problem we have at hand is that inflation is quickly increasing. The momentum is very high. The broadening of inflationary pressures is pretty significant towards the stickier parts of the inflation basket. And short-term inflation expectations, the distribution of this inflation expectation, has a very fat right tail, which sounds very complicated, but means that traders and actually consumers are expecting with a certain decent probability that inflation will remain way above the Federal Reserve target for the next 5 years, not for the next year, for the next 5 years. So when you face this situation and you're a central banker, you need to tighten monetary policy. Okay, we all agree. Now we look at what's happening in Europe, because Europe is waking up to the same problem, few quarters delayed. I mean, we Europeans like to take things very easy, and in this case as well, we are reacting with a delay as always. Now, my estimate for the neutral rate in Europe, broadly shared by other people as well, is roughly in the 1.5% nominal area. And now, you see the shots moving, and the front end of the European curve and the bonds, they're all selling off, right? Because the ECB is waking up to the situation. But where are they selling off to? If I look at what's priced in today, in the futures that basically have as underlying the ECB deposit rate over the next few years, effectively they priced the ECB deposit rate to peak at 1.7% in a year and a half from now. So, okay, we are at negative 50, George. We need to go all the way to 1.7. It's 200 basis point hikes. Wow, that sounds like a lot, right? I just told you that the neutral nominal rate in the Eurozone is 1.5. And you think that by raising interest rates 20 basis point more than a neutral nominal rate, that's going to be enough to actually slay the dragon, to bring inflation expectations down, to bring realized inflation.
Not happening. Obviously, not happening. The other thing too. Go ahead.
What
Keep
I
going.
did,
Sorry.
for last thing, what I did as well in the piece at the Macro Compass is look at the latest episode in Europe where inflation was stubbornly higher than the 2% target. So it means it was much higher and for a prolonged period of time, and the composition of the inflation, distribution was pretty sticky. And that was in the beginning of the 90s. The euro didn't exist back then. So in order to look at market reactions, I took France. France representing the barometer, let's say the middleman of Europe, let's call it like that. And then I looked at what the Banque de France had to do, George, back then at the beginning of the 90s, in terms of monetary policy to actually calm inflation down and to bring it from a stubborn 4% back to 2%. The estimate of neutral rate in the 90s was 4.5%, nominal 4.5. Do you know at which yields 5-year French government bonds traded for 2 years in a row? They traded at 9%.
Alf, I was going to say, because I'm probably a little bit older than you, I was running a mutual fund then, so I remember it well. Yep. Keep going.
So here you go, 9%. That's double the estimate of neutral rate. It's 450 basis points higher than that. So translated to today, if you want to have such a tight monetary policy stance, it's not 20 basis points above nominal. It's not 1.7%. It needs to be higher than that. And so obviously, when you have a situation like this, what markets are going to do, they're going to be chasing the central banks, right? And they're going to be chasing them and trying to push market pricing for higher interest rates. And as that happens in Europe, you can sort of translate the same recipe and the same analogy I've been making with the US too, if you want to move that way.
All right. So, this is a conversation that is not held between polite men and women. If there are any children in the room, please leave now. This may offend your sensibilities. No, I'm not going to use 4-letter words. So I'm going to take what you just said and apply it to the U.S. And, there are people like Stephen Roche, who former chairman of Morgan Stanley Asia, a personal friend. He's written a great piece. I put it in my Twitter feed about how the Fed is so out of touch with reality. They're so far behind the curve. Henry Kaufman, still alive, same thing. And you have, people who've been in the room who know markets, all the smart guys, I would say, saying one thing. And then you have the highly politicized know-nothings on the Fed, like Mary Daly from San Francisco. They're all the same. And it's like, I think I'm living in a parallel universe. So coming back to your idea of what the neutral rate is, and I guess, Alf, when you refer to the neutral rate, are you referring to a concept that's kind of broadly similar to sort of the Wixelian interest rate, i.e., set the rate above nominal GDP or low nominal GDP? Because I kind of, listening to you talk, it sounds kind of like the same thing. Are you familiar with Wixelian interest rate? Is a similar type of concept to yours?
Yeah, it's a similar, but not exactly the same. So the neutral rate in today's monetary policy jargon will be the interest rate at which the economy doesn't cool down or excessively let's say, overheat. So it would be
Right.
an interest rate that when you set it, then the economy grows at potential. Effectively, there is no hike or no increase or slowdown in unemployment rate, no increase or slowdown compared to potential GDP. Things run smooth, basically.
Okay.
That's what
Yeah.
the
Yeah.
neutral rate should be.
Okay. So that's broadly consistent. So here's my problem. I agree with these theoretical exercises that refer to sort of equilibrium in the long run, but as Keynes once said, in the long run, we're all dead. The problem is right here, right now. It's path dependency, and also keeping in mind the long and variable lags with which interest rates affect monetary policy affects the real economy. So especially when you consider it's a political item, the only reason they care about inflation now is because of political reasons. But I actually fear, in a bigger scheme of things, that the wheels possibly, if they don't get this thing in check, the wheels are just going to come off the economy completely. I mean, capitalism as we know it is going to completely blow up. I mean, it's running the risk of becoming unhinged. But what I'm concerned about in the short run is like, okay, they seem to think these geniuses on CNBC breathlessly hang on to every word from Jerome Powell. Like if they just increase rates by 25, they were debating 25 or 50, 50 or 75. They're so far behind the curve. And not only that, what's happening now is largely by dint of actions that were taken a long time ago. So the idea that they're going to be able to do anything in the short run to influence election outcomes, I think we're well past that point right now. And so my concern is that rates are going to go up an unspeakable amount. And okay, so the most interest sensitive parts of the economy, housing, fine, they're getting shot. We know that. Okay, and that's not good. But if the real casualty from this is, and I actually think this is a good thing, what's happening, because and I don't want to get into too much of an existential philosophical discussion, but if we are by doing this, trying to normalize the system, we had excessive fiscal stimulus, excessive monetary stimulus, and bit by bit the system's trying to regain its footing. That's actually a good thing, not a bad thing. It's a good thing. And if all the malinvestments, of all the bullshit, 30 times revenues, Kathy Wood type stocks get killed, and Tiger Global goes bankrupt because they're stuck in the liquid stuff, I don't care. As a matter of fact, we need to get the rules of engagement back on a proper footing for the economy. So looks, if you're a real company and you make profits and you're not selling dreams and narratives and you have cash flow and a decent balance sheet and you didn't lever yourself up excessively like American Airlines. I mean, the idea that interest rates go up 50 basis points, 100 basis points, who gives a shit? It's not going to affect you. I mean, because policy is still so stimulative. To your point, interest rates are so far below, given where pricing is right now. I don't think raising rates is stopping anyone with a legitimate investment purpose from investing. What's stopping people from investing is if you're a company, you look at CEO attitudes and consumer attitudes. What's killing them is not growth. What's killing them is inflation. So coming back to the question, I'm sorry, I really fired up this morning. I had too much coffee. Um, do you think it's a reasonable chance that I don't know how you want to frame it. I want to pin you down to a specific answer, but let's talk about the right tail. Do you think? Do you? I don't know if you're a gambler or one top shot. If I said to you, or over under. Okay, if I said to you, do you think pick whatever interest rate you want? I'm just going to pick the U.S. 10-year because I got that on my screen. You think we're going to see like a 350 U.S. 10-year sometime this year, or pick a number? Do you think we've seen the high end rates? Like, where do you think you see rates going from here?
So the answer I have to give to that question is short-term higher, both in Europe and in the US. And the reason is relatively simple. I mean, there are three paths ahead of us. The first is that inflation slows down, George, but it has to slow down faster than the Federal Reserve already expects it to slow down, and faster than inflation swaps are already pricing it to slow down. Because what people actually misunderstand is that, yeah, inflation has peaked. Look at the latest year-on-year numbers. Yeah, okay. But do you know that the Federal Reserve themselves expect inflation to be below 4% by year-end on a year-on-year basis? And based on that, they've still promised us to hike to above 2% by year-end. So if you want to see a looser monetary policy stance, then the pace of slowdown in inflation needs to be faster than what's already expected. If that happens, then the central banks can take the foot off the gas pedal. They can just ease down because there's no reason to over tighten conditions if they're getting what they want at the pace they want it, which is a solid inflation slowdown. What is the probability that's going to happen? I don't think it's very, very high, looking at a bunch of stuff going on across the world right now, as you already said it too. The other two scenarios are the, let's say, base case scenarios. And now you're talking about tails, and that is interesting. So let's say we need to do a trade here, George, and we want to look at trades. So you said 10-year treasuries. I'm going to say let's do Fed funds, okay? Everybody can immediately understand that. So let's say Fed funds or euro dollars, right? So right now I'm on my Bloomberg terminal, and I'm going to go with the euro dollar December 2022 contract, which for people here listening effectively replicates the LIBOR at year end, which if you apply a spread gives you a very good idea of where the Fed funds rate will be by year end. And let's say that, what do you expect, George? What is the probability, the tail risk that we have right now, that the Fed has to hike rates to what by the end of the year? 4%, 5%? To slow inflation?
Well, I'll answer your question with a question, which is, I don't see. I think it's extremely unlikely if you just start running the numbers and look at the monthly CPI numbers that I think are in store, considering the energy cycling back up, food is up, the bullshit owner's equivalent rent thing is a travesty. I think inflation is going up in the coming months. So the idea that we're going to be at 4 or 3 or whatever the number is by the end of the year, just not going to happen. I mean, I really like Jim Bianco's definition of transitory. He says transitory is inflation where if you don't do anything, it'll go down by itself. And in my view, the answer to that's no. Or put it this way, maybe it's peaked, maybe it hasn't. I don't think it has. But if inflation is 6 or 7, 3 or 4 months from now, we're still in the shit. Excuse my French. So I think we're screwed. I mean, what would your pushback be to that?
No, I was just trying to understand what is the market pricing in. You asked me about tails, right? So let's look at what the market is pricing in. So the market right now is a model outcome for Fed funds rate to be at 2.7% by year end. 2.7 roundabout, let's say 2.7. Okay. Okay. So let's try to price what is the tail risk that the market is assigning that Fed funds rate need to be 1 full percentage point higher. So that's 3.7. That's quite some hikes to deliver between now and December. But let's go for it. 3.7%. Okay. So if I do a call spread and I structure it, I pay 6 cents or 5.5 cents more or less to buy this one. And then I'm doing the calculation in front of you guys. So allow me a second to give you an implied probability from markets. I think it's a useful exercise. So that's stay with me for a second.
No worries.
So the market is assigning approximately a 10% probability of that to happen. Here is your tail risk priced, George.
So hold on. The payoff end. So you pay 6 cents. It's a spread. So what's your upside? You can make 100 6 cents to $1. Well, what's the payoff on that? I'm sorry.
So basically, on this option here, you end up paying, you pay basically 6 cents, and I made up the call spread such that you have a payoff roughly of 9 times compared to what I told you before.
9 times.
Yeah,
that's nice. That's nice. Yeah.
So it's 12% implied probability, roughly. I mean, I didn't run the full thing, but roughly 12% probability. So if you want to understand what the market is pricing in, 12% chance that we'll have to hike rates to 3.7% by year end. Now, if you believe that the Federal Reserve, that inflation is going to remain stickier than what it's already priced, so that instead of having a slowdown of inflation all the way down to 4% on a year-on-year, it actually remains at month-on-month levels, George, that don't allow inflation to slow down by the end of the year. The reaction function of the Federal Reserve is not linear anymore. That's what people are not, I think, estimating with the right probability in markets. The same for the ECB, by the way, because when policymakers, George, when they are in a comfort zone, so where inflation and inflation expectations are between 1.5% and 2.5%, George, in that case, they can react very linearly. They can say, if inflation is going up a bit, I'm going to react in a linear fashion. I'm going to hike a bit. I'm going to tighten a bit. And when inflation is slowing down, I'm going to loosen a bit. But once you go close to the danger zone, which for a policymaker means losing control, losing credibility, which means inflation is below 1% or inflation is above 3.5% for a while. When you go towards the danger zone, George, the reaction is not linear anymore. the reaction has to be a Volcker-like reaction. I mean, Powell mentioned Volcker, I don't know how many times over the last few months, and people are debating whether he's able to pull a Volcker, a full Volcker. But the market here is pricing in a 10% chance of 3.7% Fed funds by year end, which would be a 40% Volcker, a 50% Volcker. So the
Right.
market is pricing in basically a 5% Volcker reaction.
Right.
Now,
Right.
do you think that's enough? I don't know. It's up to you guys, but I'm just giving you the
No,
probabilities here.
yeah, but also we have a lot of energy friendly folks in the room here today from the Canadian oil mafia. I don't know if you're familiar with them, but there's a whole bunch of these guys. I'm an honorary paid up member, even though I'm American. Believe in energy, particularly Canadian energy, and so I think another real risk that's not being appreciated by the sort of macro tourists, if you will, if you really roll your sleeves up and do the work and look at what's going on with energy, I think you reach a far more dire conclusion. In other words, we tend to try to forecast the future through the lens of the past, and we have a very different energy situation right now where excess production capacity is dwindling. We've had 8 years of a 70% decline in capital expenditures in energy. Energy CEOs are being greenwashed. Don't you dare put another hole in the ground. I think we're marching full speed into an energy crisis. We may get inflation coming down a lot eventually because we're going to go into a huge economic downturn. But it's a question of sequencing. And, so if you think that the tail's underpriced, I think is what I'm hearing you say, and you say you want to be short the S&P, and I want to go to questions because I don't want to take up too much of your time. The trade that I've been on for a year now has been long energy, short ARC. It's up, I don't know, 400%. I think it's still the right trade. So if you were just to think about the rotation in the market, rather than you and me bullshit each other, well, the S&P is going to do this, that, whatever, but just think sectorally. Do you think it still makes sense to, I want to be involved in companies that have pricing power, where there's been underinvestment, short duration, high correlation to rising rates, et cetera, et cetera. And I want to be short the ones that are price takers, overvalued, long duration, malinvestment, cash flow negative. And to me, the macro world that you're describing still suggests that that's the right way to be. So right here, right now, do you think being long something like energy and being short something like ARC, forget about the day-to-day, week-to-week, anything can bounce. I get it. Energy's overbought, ARC's oversold. I get all that. But looking out, say, between now and the end of the year, do you think that trade makes sense?
Yes. If you ask me whether I want to do that trade between now and the end of the year, then the answer is yes. Between being neutral, selling and buying the trade, I'd rather buy the trade. As a friend of mine would say in a hedge fund, George, he would always ask me, Alf, do you need the second leg of the trade? Why do you need the complexity? Would always be his question. And I respect this guy. I think he's very smart. And in this case,
Yep.
the complexity, George, would be adding the long side of the trade, right? Which is the energy side of the trade.
Yep.
And actually, you might want to argue it's going to make more money than only being short risk assets. I mean, for instance, if you were short the S&P, you would have made 15% year to date. If you were long oil against it, you would have made a gazillion more. So in that case,
oh yeah, yeah. I don't have the number right in front of me, but that trade this year to date is up over 100% already.
All right.
And the thing is, I believe we're going through a regime change in on the macro side of things. And this trade is not a trade; it's an investment. I think this idea, I think this is going to run for years. So, by the way, Alf, have you actually looked carefully at energy by itself, leaving aside the overall macro framework itself? But sometimes people that are too close to the trade are too close to the trade; they can't see it. But when you look at energy itself, do you what's your sort of as an informed macro tourist, as a smart macro tourist? What's your sort of 2 cents on the energy trade? Leaving aside duration and all this other nonsense, just the idea that we have a huge supply problem right now. It's not about demand; it's about supply. And if you go back and you look in the last 50 years, you've only had 3 occasions where demand for oil has gone down. It's always the supply side, which is the problem. And boy, do we have a supply side problem in spades. So, do you have any thoughts about energy, or would you rather not answer that question? Is that beyond your expertise?
It's not my home turf, but if I look at global macro and asset classes, it screams as a place that is very, very tight supply-wise, and people are focusing a lot on the demand destruction, and they're going to say, well, if ultimately we go into a recession or a strong growth slowdown driven by monetary policy, tighter monetary policy, then ultimately demand has to roll over, and commodities have to roll over too.
Yeah.
Well, that might be cyclically right. So there is a cyclical aspect to it, and then there is a more structural aspect to it. And on the structural aspect,
Right.
one comment I can make, George, on that. I mean, there are plenty
Sure.
of commodities that obviously need to be produced, and they need capex much more than what we have done over the last 10 years because of the energy transition. And so people are, let's say, extrapolating relatively quickly that, the capex we need in lithium or in aluminum or in copper or whatever is 3 times more what we have had over the last 10 years. So prices need to go up, right? And while I do subscribe on the, let's say, underlying assumptions behind that, there's one thing I'd like to say. Obviously, technology is gonna advance as well over the next 20 years. So you cannot assume that with the technology we have today, we are going to be facing this high capex to the same extent as if technology wouldn't advance over the next 20 years. So always keep
Yeah.
that
No.
keep that in mind. But
Yeah. I get your last point. I guess what I would always say is, there's a the story may be right, as my friend Joel Tillinghast, the Fidelity fund manager of the low price stock fund, always says. The story may be right, but the price is wrong. In other words, what's already in the price? And I struggle. I look at I'm going to pick on Kathy Wood. It's my favorite pastime. And I look at the garbage she has in her portfolio, and I love. Someone tweeted out the other day. She was complaining. She says, "Well, if you're short ARC, you're short American innovation." Somebody said, "No, we're just short your ability to correctly identify innovation." So, but in any event, the story may be right, but the price is wrong. Is my point. But in any event, enough of that. All right, so Alf, we only got another 10 minutes or so I want to get to some
Mhm.
questions. If anyone has a question, by the way, I urge everyone to follow Alf if they haven't already. And Alf, I can't wait to read your latest edition of your newsletter. You said it'll be coming out within the hour. Hopefully, once you get off this call, you can hit the send button. But if you have a question, please raise your hand. We're going to go to Philip first. If I don't know you, please DM me your question because I don't want extraneous questions. So, Philip, good to see you. What you have a question for Alf? What's up, Philip?
Hey, George. Good morning. Yeah, Elf, great to hear from you guys. So, I think there's some cognitive dissonance going on, right, with respect to the Fed. We saw during the great financial crisis the decisive actions they took to lower rates, right? And then we saw it again during the pandemic where Powell took the rate down. I think it was 100 or 150 basis points within, literally weeks. And yet, there's this massive inflation happening. We see it everywhere. The the official statistics by anyone's reasonable estimation are massively undercounted, right? I mean, you look at the combination of shrinkflation with the actual cost of goods, whether it be groceries, fuel, or all the other things that have fuel embedded in it, right? And inflation is raging. Yet our politicians, both stateside and Lagarde in Europe, Alf, are slow rolling it, like unbelievably slow rolling it. So you've got this decisive action during the pandemic, and then you have this, they're saying they don't want inflation, but I think they do. I think they want inflation, and I think they want inflation, above trend, right, above 2%, 3, 4, 5% for many, many years, because that solves a really big problem for all Western governments around the world that have massive debt to GDP. And so, Alf, the question is, what's the probability that we're just blatantly being lied to, and that the Fed, the Treasury, Congress, they want and need above trend inflation? And what are the implications for that, both in the bond market and in equity markets?
Oh, it's a very good question, Philip. The answer to that is that although it sounds very palatable to believe that that is the plan, I don't think that is the plan by design. And the reason is that once you let the inflation genie out of the bottle, it is very, very, very painful to get it back. And so the risk reward from a policymaker perspective to let inflation run where it would need to be able to run for the private and the public sector debt levels to be deflated away, it is so high and so durable, needs to be so durable over term, that it seriously risks an anchoring inflation expectation. It then starts a spiral that no policymaker wants to be held accountable for. So despite it's palatable, I think it is not the best risk-reward strategy from a policymaking perspective. I used to run a $20 billion portfolio, so I was lucky enough to have the chance to talk to these policymakers. All they care about, really, all they care about is to make sure the status quo is preserved. No hero, no big plan, no great reforms, no great agenda. It's all about keeping the status quo. And running inflation at 5% or 6% for 10 years.
So, Alf, how do you explain? How do you explain? Both.
Hey, Philip, you're Alf. Can you hear him? I think we can't hear him anymore.
Sorry.
Yeah, Philip, go ahead. We're losing you.
I was just saying, how do you explain then the fact that Powell isn't doing a Volcker or anything close to it, as you suggested with some of the arithmetic you laid out?
Phil, let me just take that. It's real simple. I've talked to a lot of people about this. The Fed with their frickin' 400 egghead PhD economists, they're complete Keynesians. They're living in the past. They don't get it. I actually, if they were lying, that actually might be better in the sense of giving credit for being smart. They're just lying. I actually think it's far worse than that. I just think it's arrogant, massive groupthink. Thanks for the question, Philip. I want to move on because Alpha's only got a few more minutes here.
Yeah, great. Thanks, guys.
Yeah, let's go to the tourist. Tourist, how are you? What's up, man?
Hey, guys. Good. This space has been absolutely fantastic. One of the best I've joined in a long time. My question is just regarding, so you touched on energy, specifically oil. I'm wondering if I can get your thoughts on natural gas and specifically focusing on North America's large exports to Europe, just with the...
Sorry. That's not a question for Alp. Please.
I thought it was for you. Sorry,
no. If we could just save that for later because Alf has to leave in like 5 or 10 minutes. So it's a good question. If you could just hold it, please. We've got Alf is very gracious this time. I want to save
my
the questions
apologies.
for Alf. Okay, no problems. Let's just hold the question. It's a great question. Darren, good to see you. You got a question for Alf, Darren?
Yeah, George, Alf. We tend to treat you like a crystal ball sometimes, right? Where we just want to shake you and see what else you see. You mentioned some of that right tail skew in terms of probability outcomes. What is another less likely scenario, but one that has the most impact in your mind in the short term here when we look at U.S. markets on a right tail skew? Is it in energy? Is it somewhere else? Where are you seeing some of the most less likely but the highest impact macroeconomic scenarios?
Beautiful question, Darren. I always love to think about tails and how they're priced. The answer is pretty straightforward, and it's the housing market, which is very difficult to trade, unfortunately. But if I am right on the Federal Reserve having to Volckerize a bit more than what's priced in, then mortgage rates have not stopped going up. And if mortgage rates haven't stopped going up, it makes the monthly mortgage installment for the median house in the US even less affordable than it already has become. And then people say, yeah, but there is no supply of housing. Give it a couple of months because the amount of constructed houses that are coming for sales in the US market, even adjusted for population over the next few quarters, is relatively large. So there are reasons to believe that we are not going to see a 20-30% drawdown in house prices, but the housing market is nothing else than a big levered real yield play. At the end of the day, 87% of transactions in the US housing market are backed by a mortgage, 85% LTV mortgage. So you understand that even if you inflation adjust everything, if wages aren't going up and mortgage rates are going up, the only variable to adjust the equation is for house prices to drop a bit. So I'm trying to figure out how to play that via leverage, Darren, and I haven't been able to identify yet a call spread or a put spread or a tail pricing for what's priced in terms of house prices going forward. But analyst consensus out there, if you want to use that, is for house prices to increase in nominal terms by 12% year on year in 2022.
Yeah, not happening. I can say that because my girlfriend is a very big real estate broker here in the New York area. Not happening. I'll tweet out some stuff later, but you're already seeing supply increase significantly. We can get caught up in anecdotes, as we know real estate's a local affair, but overall, that's just not happening. So I agree with you, Alf. I think that's a real risk. And so, yeah, and that has obviously consequences for the economy more broadly. But Alf, let me just go back to the question I asked at the top. So say we get the slowdown in growth. Clearly, we are getting slower, right? Say we get, I don't want to argue back to recession. It's not a recession. Let's just say growth really slows down, but inflation is still hanging. I mean, I want to paint the nightmare scenario for equities, which I actually think is where we're going. You're going to get this slowdown in inflation. Maybe you get it, maybe you don't. I don't know. I mean, some smart guys I follow think inflation is going to go higher in the coming months, but leave that aside. Let's just say inflation is still a clear and present danger going forward. That inflation is anywhere from, I don't know, 6 to 14%, 3 to 6 months from now, and you got slowing growth. I can't think of a more deadly scenario. Slowing growth, profits getting absolutely destroyed. I mean, you look at the profits from some of the retailers recently. I mean, costs out of control. They're now having to bid up wages. I'd remind everybody, wage inflation is now accelerating. That's a process, not an event. It's accelerating as we get the shift in consumption from goods to services. What if we wind up, Al, 3 months from now? Not what if, but what's the probability, I would say, that 3 months from now, sorry to disappoint the CNBC crowd, but you still got inflation, I don't know, 6, 8, 10%, and growth is slow and profits are really getting destroyed. What's the chance that happens? And if so, where do you think the market would trade to?
Oof. So I invite people to subscribe to the Macro Compass. My piece is going to be out in 5 minutes after the spaces, and it summarizes basically all what we are saying here. I attach probabilities to each scenario, and the probability you are describing right now, where the inflation momentum doesn't really decelerate, I attach about a 20-25% chance of that scenario, and then I try to look at what market probabilities for that scenario right now implied in different asset classes, and the answer is below 10%. So obviously, George, if you think that's going to happen, then every trade that is short risk premium, short risk assets, short bonds, short gold, short everything which is not cash, volatility, or the very few selected macro asset classes that can preserve purchasing power, pricing power throughout that period, anything that is not that is going to get clobbered. Very simple.
And I mean, and Alf, I would just say another thing too related to that. When people say, "Oh, I have to buy something," or the phrase I really can't stand, "I got to put money to work." I hate that phrase. What do you mean you got to put money to work? Says who? Okay, what if we had the everything bubble, and we had the sort of we had the everything bubble, and now we get the everything bear market, and we had what was called the rational bull market. Even though prices were high, they were going higher. The expectations theory. People buy high and sell higher. Well, this is the rational bear market. We're not even below fair value. So, with valuations still being, extended, profit margins about to get destroyed. All right, liquidity continuing to tighten, the economy about to slow. What I miss, Alf? Other than that, what could possibly go wrong? I mean, I'm sorry, but people don't like me because they say I'm too bearish. No, I'm not bearish. I'm a realist. So I don't know. I mean, I just enough of my rant. So Alf, I know you got to run, but let's just do 1 or 2 more questions. Michael, good to see you. What's up, Mike? You got a question for Alf?
Yeah, hi, George. Hi, everyone. Alf, this is fantastic. My question, do you see a yield curve inversion? And what do you think about the value growth, long, short, going forward? Thank you.
So the answer to the first question is yield curve can be defined in many ways, but let's say 5-year against 30 years in the US, it is already inverted. And you're like, Alf, you're looking at the wrong screen. My screen says that 30-year treasuries are 3.08 and 5 years are 2.91. So it's 16 basis point above zero. I mean, what am I looking at? Well, you're looking at the wrong curve. The right curve is the OIS curve, overnight index swaps. Sounds extremely complicated, but it's really not. Again, it's on a piece called the Bond Market 101 series on the Macro Compass, where I explain why this curve makes much more sense to look at than the Treasury curve. It only replicates the expectation for Fed funds rate over time. That is what really we are interested in when looking at yield curves. This yield curve has been inverted relentlessly, non-stop since February. It's been inverted for 4 months. It's predicted every single recession. It has not over-predicted any recession, contrary to other indicators. And it has been inverted for 4 months in a row. So it is basically already inverted from that perspective, and it's not disinverting anytime soon. And I forgot the other question. I'm sorry. Oh yeah, the value growth. Yeah, that's a function of inflation. Ultimately, it's a function of inflation and duration and interest rates. Again, if you think inflation is going to remain at least stickier than what central banks expect, the reaction has to be more than linear, more than what's priced in. And if that is the case, then anything that is valuation intensive, a proxy for bonds, gets absolutely clobbered. If you think otherwise,
So Alf, just to help everybody in the room, could you just repeat that again? Because it's only like geeky, smart guys like you that do bonds. For dumb equity guys like me, we kind of fall asleep when we start listening to this. But if people want to learn more about this yield curve, what is it? Where should they be looking, and what should they be looking for, please?
I have released a series, it's all free, guys. There is no paywall. There is nothing. You just go on the macro.
Hey, Alf, I'm going to tease you. Did anybody read it, or is this recommended reading if you want to fall asleep at night? Anyone actually read
Well, it's 50,000 subscribers to the newsletter, so I guess.
No, the letter's good. No, the letter is good, but this bond thing. Did anyone read this bond thing?
Yeah, a couple of guys, yes. And what I try to do, George, in the end, is try to share some of the knowledge I've accumulated on the bond market and other global macro stuff. So in this series, I explained how to look at bond markets, and one of the pieces on the Bond Market 101 series on the Macro Compass is dedicated to the OIS curve, overnight index swaps. I explain why you should look at that rather than at the treasury curve, where to find the data to look at that. It's all publicly available. Go and check it out, guys, because it's going to take too long to explain on the on the
That's
pod.
fabulous. That's fabulous. That's fabulous. All right, listen, Alf. You've been more than generous with your time. We're going to keep this room open. If you want to stay for more questions, great. But I know you said 45 minutes. We're already at 55. But I think probably you want to get that issue out. So we're going to keep this room going for a while. But I want to thank you. This has been fantastic. It's been one of the best spaces we've done. And I hope you'll come back because, as you can appreciate, this is not your normal space. We try to call them like we see them. We don't try to sugarcoat it. So I want to thank you for everything. This has been fantastic.
I really appreciate you inviting me, George, and every time you want to have a chat with this nice audience here asking questions, please call me back and I'll be back.
Well, that's fantastic, Alf. All right, so everyone follow Alf, and you'll get that follow his Substack. You'll get his letter coming out. So that's fantastic. That's awesome, Alf. Thank you very, very much. Okay, so let's see. So Crypto Bull, you haven't spoken yet. What's up, Crypto Bull?
Hello. Well, I had a question for Alf, but I can ask the same question to you. We're seeing yield spiking everywhere, and production inflation in Southern Europe is up 40% year on year. So I'm sure you're familiar with the European crisis, Euro crisis, and it looks like there won't be a whatever it takes moment this time because ECB is turning hawkish. So what's your forecast for Southern Europe, and what could be the consequences, not just for Europe, but for the world economy? Because 10 years ago, it was like, it looks like it could become some sort of earthquake for the world economy. Thanks.
Yeah, I mean, it's like, I've been investing in European markets for almost 40 years now, since my days at Fidelity. And that question about, is the euro going to blow up in the European Union, blah, blah, blah. I try not to focus on that too much just because I don't think I have any particular variant perception. And I think it's a prisoner's dilemma. They're stuck in this prison of their own doing. And yeah, there are a lot of costs to be paid by staying with this, but equally you have to consider what are the costs that are incurred if you let it go. And I just think they'll do anything and everything they possibly can to keep this thing together. It was funny when Alf was talking earlier about officials not telling the truth and lying. I remember Jean-Claude Juncker, back, when it was 10 years ago, a dozen years ago, time of the crisis, when the going gets tough, you have to lie. So they will cheat, borrow, beg, steal, to do everything to keep the European experiment together. That's my own 2 cents. But so I don't know. I just think they're more. It's an important question you raise. I just think it's beyond economics. It's a political thing as much as anything, and therefore, I don't think it's worth spending a lot of time on. So, hey, KFAB, good to see you, my friend. What's up?
Hey,
K-Fab.
George. Good to see you as always, or speak with you, I guess I should say. So I was just going to raise, because I just wanted to listen to Alf. As always, when you get guys with that amount of horsepower, do better just listening rather than getting engaged. And one of the technical aspects that I thought I'd bring up is I think we're entering a period where people's understanding of reported inflation and their level, it's a little dorky, but I think it's important, meaning that the official inflation data is specifically engineered not to show inflation. We know this. That was publicly disclosed. It's, public record. There's been talk about making it even worse at times as part of so-called entitlement reform at times. So what was very unusual about the last 12 months is that because of the supply chain and the invasion and everything that went on, and the shifts in supply and demand curves because of the massive amount of stimulus, that nexus created a very pervasive increase in prices. So it was, all of the statistical gymnastics that they've put in to try and suppress reported inflation, like hedonics, substitution, all these various mechanisms didn't work as well because you had such broad increases in prices across the board. And I think what we're starting to see now is some dispersion emerge, meaning that because the consumer's kind of rolling over, the economy's very likely rolling over and probably going to enter a recession in the next 6 to 12 months. You're going to have increased dispersion, and that doesn't mean an inflation that we're all living with is actually dropping, but what it does highly suggest is that reported inflation is going to come down. And because we live in a world of perception and markets are going to respond to government numbers regardless, I think that's an important thing to factor into everyone's calculus, because they're going to say, it's coming down, whether it's not, is almost irrelevant in a sense. So I just wanted to raise that point, because I think it's something that a lot of people aren't aware of. And it's coming. I mean, we're already seeing like the Dallas trimmed mean PCE rolling over. I mean, they're going to make up whatever inflation number they want. And it's hard to, it was hard for them to hide things, so to speak, in the last 12 months because of the factors I mentioned, but that's probably ending.
So, KFA, let me understand something from you. So, I get you're saying certain prices are rolling over. So, all the CNBC guys are breathlessly think it's all about used car prices. They may derive succor from that. The other side of it is, though, you got oil cycling back up, food cycling back up, owner's equivalent rent, which they have to bleed in. They have that fraud of 5% inflation over the last year when the real number is like 20 or 25%. That's 32% of the CPI basket. So, netting all that out, do you think the reported numbers, I know you said dispersion, but when you put it in the blender and mix it all up, what do you think happens to the printed CPI numbers in the next few months?
Yes, CPI is a little harder, but the one that they focus on, kind of core PCE, that's the so they're going to back out food and energy, so that magically disappears, right? So the global energy crisis and the famine that might be hitting much of the world in the next 12 months, we'll just pretend that that's not happening. The rest of this kind of these machinations then get amplified in that non-core basket that they have in this PCE number.
But do you think the market's gonna? You think the market's gonna go for that bullshit? Because I mean, it's one thing to say ignore food and energy when it's a little thing. When it's sucking up all the oxygen in the room, like you think the market's gonna give them a free hall pass on that?
That's a great question. I don't know. I don't have a strong sense on that. So I think that's where structuring positions, depending on what might happen there. Meaning that the curve's probably going to steepen. The question is how's it going to steepen? Because it always steepens into recession. The question, and the Fed will likely pivot, and I'm going to write about this tomorrow. I mean, the Fed always pivots. I mean, this idea that the central banks reversing course after they tighten into a recession somehow magically fixes things is nonsense. Like they always pivot late, other than the '94 tightening cycle. And if we're going to get a recession, they'll follow the recession down. I mean, that it's kind of independent of that. So the question is, to your point, I think, is whether the long end and inflation expectations stay anchored. I'm of the view that the fake inflation, as I call it, I joke, the phony baloney inflation, that we've known about this since the late '90s, and yet the entire investment industry and institutions have adopted the fake inflation calculation.
Yeah, I know. I mean, that's the cousin, the analog to non-GAAP earnings. But I guess the problem is now that the people can smell the baloney starting to smell really bad.
Yeah,
it's one if inflation is understated by a little bit, but it's a complete joke now. Okay, so like my view is I agree with what you're saying, but in terms of the market response function, like what's the market going to focus on? I'm not sure the market's going to give them a free hall pass on this.
And they may not, but you mentioned one of my favorite phrases from Michael Steinhardt, the variant perception. And that reminds me of the '81 to '84 period when he almost blew up because he went long bonds, long-term bonds a little early. And, real rates, Volcker and the tightening did crush inflation, yet the long end did not come down because people were so traumatized from the long-term battle with inflation and what had happened that you could still buy the 30-year at, I don't need to tell you, you were there, you could buy the 30-year at 12% when inflation was at 4%. Because no one believed it. So I agree with you. Like I'm trying to intellectually stay agnostic because I'm in 100% agreement with you. I'm not sure about whether or not the markets will price that in this part of the cycle, meaning that it may require. I could see a scenario anyway where the recession knocks some of these things out enough. If the recession's deep enough and bad enough, and then global, that's the key. Like, a lot of the problems, the worst of this cycle, are outside the U.S. Emerging markets are going to get funneled. Europe.
And the other, I think it's more important too, because at the end of the day, you and I want to make money. We can push the ball back and forth all day long, and it's a recession, it's not a recession, it's inflation, it's disinflation. At the end of the day, how do we freaking make money? Okay, and where I come out on it is that you can either have a recession if Powell rediscovers Powell discovers his inner Paul Volcker, or they can whiff and try to cheat and pretend like there's nothing to see here, move along. In which case, I think you're going to get, inflation is going to cycle back up yet again. In other words, that's what I'm trying to say is I'll give you door number one, which is recession, door number three, which is inflation. What I'm not going to give you, door number two, and I have heavy security guards standing in front of this, no Goldilocks for you. Goldilocks is not in your future. And therefore, I think equities have been sentenced to death. What would you say to that? What would you say to that?
That I agree with. I guess my big question is whether or not we get a disinflationary shock first, and then that kind of opens the door towards longer term inflation expectations de-anchoring.
Yeah, right? And I could see that, but just again, it's path dependent. We get this deflationary shock for $50 in double jeopardy. Is the market up or down on that? So the point is,
I think the market's way down on that.
Yeah, I know. So the point is, checkmate for equities. Period. Game over. Tiger is bankrupt. They just don't know it yet. Okay, they're going out of business. You saw the numbers today. They're now down 51% year to date, having been down 7% last year, and they're stuck in illiquid, loss-making crap. Okay, and it's not just Tiger going down. They're going to take down all the other idiots that are stuck in the same rubbish. So I think again. We could have deflation. I totally get it. Okay, we also, if they do everything but just try to stop the deflation, maybe we get the inflation. Maybe we get things like ARK going to 10, and Kathy Wood. It ain't oil that's going to go to 12. It's going to be your stock price is going to go to 12. Okay, when oil is at 200. So I don't know, but what you are not allowed to have. Sorry to break it to the CNBC crowd. You're not allowed to have Goldilocks. That's just not, that option is not one of the options that you get to select. It's just not available to you. Sorry, I'm all fired up this morning, K.
No, I love it. But so my scenario is I could see oil going to 200 while we're going into deep global recession and overall inflation data coming down.
Yeah, I agree with that. I agree with that. Yep, 100%, 100%. Always great to always great to hear your comments. I love it, absolutely love it. All right, let's go back to we had the tourist who had I think it was an LNG question. Tourist, did you want to ask your natural gas question?
Yeah, that'd be awesome. Great content so far. We actually just had also just on the energy front, the EIA report came out and it was a massive draw. Obviously in shoulder season, which is interesting.
Who could have possibly foreseen that? Sorry, go ahead.
No, I agree. It's funny. It was quite large though. It was 10 million, and it was offset by a 5 million strategic reserve. But nonetheless, my LNG question. So right now, I guess North America LNG natural gas prices have pretty much gone parabolic. They're exporting a ton to Europe. Do you see this as more of a one-off, or do you see this as the beginning of a trend as Europe starts to build LNG terminals to kind of get as much as they can away from Russia and as much from North America as possible?
You remind me of my grandfather. You like to ask questions you know the answer to. You know the answer to that question. It's door number 2. Here we had now the emergence of a globalized LNG market and natural gas market, which when you got natural gas at whatever it's $50 in Europe and it's $8 in the U.S. I mean, I think there's a little bit of room there between the bid-ask spread. So no, it's why natural gas. I mean, who knows? Short run, it goes up, it goes down, but and also my Canadian oil mafia friends, they can talk to you about long-term the construction of terminal capacity in British Columbia, and going to export a lot more of that stuff to Asia and so on and so forth. So and the new thing, which we haven't really talked about much. I was at an energy dinner last night. Raymond James had their energy guys in town. We were talking, and it would seem that some of the institutional crowd, even the ESG crowd, is now starting to come around to natural gas because they realize they're screwed. And we talked about this months ago, how natural gas would be adopted by the ESG crowd because it's green, relatively green, yada yada yada. Well, guess what? And I hope that there'll be some sense. There'll be some adults put in charge. We get a landslide. And I don't want to get into politics. It's not, but just purely from the standpoint of energy. And you may argue a Republican wouldn't do any different, but one thing that's true, very obvious to me, the Biden administration. It's not that they're. I mean, you could say, well, they're doing this on purpose because they want to, accelerate shift to ESG and green, all that kind of stuff. No. I think it's far worse. I think they're absolutely clueless as to what they're doing. We are walking into a major energy disaster. And coming back on K-Fab's point, I would actually say, if you said to me, George, what's the most likely scenario to give us a deflationary shock and a recession? I'm not worried about WeWorks going bankrupt because they can't float their bonds. The hell with them. They should go bankrupt anyway. I think what's far more likely, and Sohaib I know is getting excited here, maybe he wants to weigh in, is that we just get energy to the moon, and it just crushes everything. So, I took down my energy exposure pretty significantly a few weeks ago. So I've kind of missed some of this last move up here. But I just took my exposures down overall because I've had an unbelievably good year. But, my fear would be that energy just is a runaway freight train to the upside. And just like you saw in 2008 when it went in Fuego, the energy stocks stopped working because the market was starting to worry about a recession and so on and so forth. So I could totally see a deflationary shock. And for me, the most likely source of that is runaway energy prices. So anyway, I hope that answers your question.
No, it's if can I just add one more part to it? Do you think
Sure.
in a couple of years, so we obviously have LNG Canada connecting Canada to Asia, and then I guess the US is shipping big time to Europe. Do you think the natural gas market evolves into kind of like a global price, like it just turns into a global arbitrage?
Yes. Next question. No more obvious questions. You made your point. Thank you. Ali, you got a question, Ali? Welcome. What's up, Ali?
Yeah, George. Hi, George. Thank you for the valuable content and the debate. I just have a question regarding emerging market credit and sovereign debt. I mean, in my opinion, this is the kind of elephant in the room that we barely look at, given all the monetary action in the U.S. to a lesser extent in Europe. We have higher and higher rates, shortage of dollar, higher energy prices. I'm thinking particularly about net importers of commodities, Morocco, Egypt, etc. We already had Sri Lanka blew up early this year, Lebanon defaulting. I mean, what's your take on emerging debt for the upcoming time? Thank you.
Great question. Yes, I mean, as you rightly point out, there are a lot of stresses and strains out there. I expect it's going to get worse. One thing I would say, generally speaking, emerging market balance sheets are better than they were in the last cycle. However, it's a very heterogeneous group. You've got cripples like Argentina and Turkey, which are in a really, really bad way. Other countries where they've haven't run such large deficits in recent years, and so I don't think it's as widespread a problem as it was in the last cycles. Also, the dollar, I don't know. I mean, we understand why it's gone up. No one predicted it, really. All the smart money was bearish in the dollar. I don't know what to make of the dollar right here, right now. I think we get to a point where, as long as the Fed's talking tough, okay, but at some point, when we get to the point where they're going to cry uncle and they'll blink, the dollar will come off. So I don't have a strong view on the dollar right now. Some people do. I just don't. So we'll see. We'll see. Hey, KFAB, do you have a view on the dollar, KFAB?
Yeah, I'm kind of agnostic at this point. I think it's more specific pairs rather than kind of blanket U.S. dollar. Because I'm the same way. I think it's kind of hard to game what the Fed when they will blink, because we all kind of know it's coming. It's a question of where the pain threshold is because of the election year and the politics of it.
Thanks for that. I see a lot of friends in the room, a lot of smart people in the room. Come on up. We're having Carpathia come on up. Peccatiello, you got the best name on Twitter. Haven't talked to you for a while. If you've got any insights, want to update us on what's going on in the Ukraine. We really haven't talked about it that much recently. Some of the stuff I've been reading is very disturbing. So we'd love to hear from you. Jackson, love to hear from you. What's going on in the hotel space? Give us a real-time mark-to-market on what's going on in the leisure. I'm really struck by some of the comments you've made in the past about how people just don't get what's going on the cost side for companies. And Jim Walker made this point in the room 3 months ago. Going back to the 70s, remember he tells a story. He was an auditor early in his career, and back in the day we had FIFO and LIFO accounting, and depending on, because inflation was a thing. And now, I mean, I was really struck by your comments, Jackson, about how you've had to raise prices enormously, and yet none of it flows through the bottom line because the costs are just completely out of control. So we'd love to hear from you. So let's go to Carpathia and then Schmuckatelli. Hey, Carpathia, good to see you. What's up, man?
Hey, man, I want to just chime in on natural gas. I'm an aggregator. Look, I learned a long time ago to surround myself with the best and then decide. I don't know. I'm sure you guys know these guys, Gehring and I can't pronounce Rosencraig. They put out a report in November of 20, and it was seminal because I was watching the energy markets. They did an analysis of Schlumberger versus Tech or something, and it pushed me over the edge to get uncomfortably long energy in November of 20. George, I know you're there, and I'm sure there's other people, the mafia. They did something, if you don't take their report, because they did something on May 18th on the natural gas, and they did an analysis of the four major fields in the U.S. The Canadian mafia guys will know the Canadian fields, but they did a really, really sharp analysis between the current fields that are still getting new production, Marcellus and Haynesville, and they compared them to the two that have already topped and rolled over. Let me find them. But in short, our two big fields that everyone's banking on, plenty of natural gas, are acting like Barnett and Fayetteville fields. And that's all I got. They're talking about the title of the report. You can go to their website. You can hit me up, DM me. I'll send it to you. If you don't know who these guys are, they run a couple of small funds. They really, really think it through. The gas crisis is coming to America. And some of their arguments are pretty similar to what I saw in November of 20. And, some of the numbers, I'm not going to, put them out here on Spaces, but they're doubles and triples possibly. So throw that out there. Thanks, guys. Hit me up if you want that report.
Hey, Carpathia, always good to hear from you. And amen. I'm very familiar with their work. They do fantastic work. So I totally second the motion. Really good stuff. Really good stuff. Okay, so let's go to Mr. Schmuckatelli. Good or General, Colonel, Sergeant. Great to see you. Been a couple weeks. What's going on your end? And maybe because you and Longfall always have a perspective that we're all lacking. Maybe most notably share with us your view of what's going on in the Ukraine and in the Eastern Theater.
Well, it's faded to the background, George, and yet it's some of the most fierce fighting of the war. It's really turned into a vicious battle in eastern Ukraine. The Russians have made some inroads in the Donbass, but the Ukrainians are conducting a pretty effective counteroffensive, trying to take back some of their territory. I put up in the nest. A lot of people don't. We just think, they get a couple pieces. Let's sue for peace. Let's have a truce. Let's go back to our normal, comfortable lives. But if you look at the amount of territory that Russia has taken so far, it comprises a large part of the boot of Italy, and so it's not a small amount of land. I think another country is the whole of Austria is another one. You could see some of Shrub's maps up in the nest for perspective. So look, this is going to continue until further notice. The Ukrainians are not going to, happily cede any land to Russia, and the Russians are not going to yield. This is literally a battle for Putin's life, as I've stated from the beginning. He needs a victory, whatever form that takes. And so I don't really see either side yielding. I guess the only other comment I'd make is, there's been a lot of conjecture. They're going to, it just takes a bullet to Putin's head to end this whole thing. I just don't see that happening. Like, let's remember, he's a lifelong KGB agent. He knows the history of Russia and the Soviet Union. He knows how these things end for these dictators. He's taken immense precautions. We all laugh at that football length size table where he was, holding meetings with Macron before the shooting began. And there will not be a close insider that will stick a shiv into Putin's side. So anyone hoping for a quick resolution via the demise of Putin, I think, might be waiting longer than they think. That's the main thing that I have for you this morning, George.
Hey, Joe, that's great. Let me ask you a question. I saw some articles recently. I didn't peruse them as much as I might, but I saw a couple of them, 2 or 3 of them recently, talking about how Russia is really doing much better in conflict and battle than was previously thought. That there were all these stories, remember a few weeks ago, about they don't have enough supplies and this, that, and everything else, but actually they're winning. And I can't remember if it was the Washington Post or a couple places where I didn't expect to see this type of article. And they were saying, and the gist of it was, Russia's actually doing better militarily than people thought they would have a few weeks earlier. Were those articles off base, or did I misunderstand them?
Yeah, no, I read the same articles, George, and those are good, credible sources. And they've, checked their sources and gotten multiple sources of intelligence for that. And look, the thing about Russia, and we knew this at the very beginning, a lot of folks thought it was going to be a 72-hour war. Russia is the largest army in Europe. Ukraine is the second largest army in Europe. I think one sign of hope for the Ukrainians is that the United States and Europe mostly the United States is really sending them. The gloves are off. We're sending them some of the most sophisticated weaponry on the planet. And that is going to help them, especially distance weapons. that will, allow them to have standoff attack capability without, getting into the brutal fighting close-up combat. So that is going to have an impact. However, the Russians have been using those types of weapons from the very beginning. So you're asking if those, are the Russians conducting an effective campaign? Well, insofar as they're able to control the areas of eastern Ukraine that they currently control, absolutely. And they will maintain those areas, and Ukraine is trying to claw back some of those areas, but it's going to be a slog. And I think we're going to devolve into just kind of a bitter stalemate here through the summer. And then it gets really precarious and interesting. When Europe gets cold and Russia's really able to use the full force of their weapon of natural gas, it is going to be a very, very, very interesting winter in the energy markets, I believe. So, this summer, I think everyone is going to go on their way, take their summer vacations, try to forget about the war, and then autumn is going to come. And I think we're sleepwalking into an energy crisis of epic proportions because of this conflict. And I do believe it'll still be raging well into autumn.
Well, thanks for that. People always say I'm too negative. Well, thanks for that, schmuck. Joe, please stay up there because I'm sure there'll be follow-up questions. Thanks for that. Let's move on to Jackson and then Hector. Jackson, what's going on, man?
Nothing is translating. It's still the same. I'm actually wanted to talk about multifamily in the Southeast because I'm finally starting to see the consumer, aka the buyer, start to say no. T12s are coming down. So we're seeing that the consumer's starting to say no to the hotel gouging, which is refreshing. I wanted to piggyback on Kayfabe talking about that PCE, and I do agree that Powell's going to pivot. Obviously, we know this, but I do think it's going to go on a lot longer and more aggressive in the tightening coming forward because I think he's starting to listen to his base. And his base, to paraphrase the great late George Carlin, he doesn't give a fuck about the consumer here. He does not, but he's listening to his base, his targets, his Walmarts, etc. And nothing is translating. We've got to continue to move forward with the tightening. PE, I've been talking about this for a while too. We're back to 2018, 2017, where the same decks are being rotated around. Nobody's biting because things have tightened so much on the PE front. So I very concerned about all of these companies that are worthless as tits on a boar hog going forward. And I don't think that there's any support coming their way. They've got to go away. They have to.
I actually agree with that 100%. I think it's part of the healing process because we need to stop this malinvestment bullshit, okay? The sort of Kathy Wood, Tiger Global crap, okay? That is a curse on our house. That shit just has to stop. And the market will fix it. The market will fix it. So I couldn't agree with you more, Jackson. Always good to hear your comments. Really, I'm going to put up in the nest in a second a couple of housing charts which show what you were referring to. Please stay up there, Jackson. People always like to hear you. I'm sure there'll be some more questions. Hey, Hector, good to see you. What's going on? You got a question, Hector?
Yeah, George, thanks for having me up here. The beginning, when recession fears came in, all these articles popped up on my computer from Seeking Alpha and CNBC about REITs, and they're a great defensive play. This is where you want to be. And I have some commercial buildings. I'm thinking, wait a second, rates are going up. If I had to remortgage my buildings, I wouldn't be happy about that. Cap rates get screwed when rates go up. So I held back because I'm not going to buy any REITs. Just want to hear what is your opinion on REITs in this environment, if you can answer that, and is it when we settle down in maybe 6 months or so, is it a good time to get into them because rates should come down over the next after 6 months? Like, what's your opinion on REITs?
Well, I'm going to refer to Jackson, but I'll just tell you. I mean, I'm in a very risk-off type of mode right now. I want Jackson to answer that, but I think it's probably going to depend, as always is the case, on location. Are you a price maker, price taker? Real estate's, what vertical are you in? Are you multifamily? Are you in warehouses? Geographically, where are you? So I think you got to be very specific. But with that, Jackson, I yield the floor to you, Jackson.
That's what I was going to ask, Hector. What specific REIT sector are you looking at? Because again, commercial I think is absolutely screwed, as well as multifamily here. I don't have a time frame on jumping in on any of that for the foreseeable future.
No, that's a great question. I do own, like, I'm in Canada, so I have some REITs up here that have, Walmart anchor tenants and stuff like that I know are safe. The buildings are safe. The REIT might go down, but I'm no problem holding it for years and years to come. I imagine when I own a REIT, I pretend I own the real estate. If I like the real estate, I'll buy the REIT. I did have some Dream Industrial, which is the European and Canadian warehousing, but then I knew Europe was screwed going into this. So I actually put a stop limited hit and I got out. I kept my profits and it dropped significantly more. So I was very happy to protect myself there. I do like commercial more than multifamily right now in this environment, but that's my bias. But what I'm hearing from both of you, which is kind of where I'm thinking, is play defense, don't rush to buy in, and wait till this kind of macro settles a little bit. I do like owning some REITs. There are some decent opportunities right now, but maybe they're just not yet. Like, for example, SPG is one you could question on.
Yeah, Hector, let me interrupt you. As I'm reminded, I've used this line a lot from the late Richard Russell. Those who are in the room have heard me use this line many times. In a bull market, the hardest thing to do is to stay in. In a bear market, the hardest thing to do is to stay out. So I would just say keep your powder dry. If Alf is right, and I think he is, you're going to start to see spreads blow out further, heightened volatility, risk assets generally sell off. I just think you want to stay out of trouble right now. And again, the problem is, whether you're talking about a REIT or a stock or whatever, like, with a stock, you're always looking, but you're backwards looking. You say, oh, well, XYZ was at 50, now it's at 40. The PE was 25, now it's 20. Yeah, but what's probably missing is, if yields are going up, which they are, and spreads are blowing out, which they are, and if earnings estimates are maybe not reliable, maybe the E's wrong, like superficially on the PE the lagging PE looks maybe really reasonable deal, but it's not. So I would just say keep your powder dry. I hope that helps.
Thanks, George.
Yeah. Hey, Tim, welcome. What's up, Tim? Tim, unmute yourself, please. I don't know. I guess he can't unmute himself. Okay. I see we've got some others in the room. I don't know. Three Aces, you want to say something? Sohaib. Hey, Guy Cirandulo, come on up, man. People want to hear your technical view. We got a sharp cookie in the room, Nancy Davis. Nancy, come on up. Always the more the merrier. It's a great room. We keep it fast, keep it light, just helping each other. Bob Klein, good to see you. I'm just going down the list here. We've got so many good people here in the room. Three Aces, I'm getting you up here right now. Speaker. Going to run this room for till 11:50, let's say, 20 minutes. So if you got a question, please raise your hand. Three Aces, good to see you, my friend.
What's up? My brother, how you doing?
All good.
Cool. Just kind of reading the tea leaves here. Again, always in the form of a question, even though it may sound like a statement. Question to you. Talking to Dr. Anas extensively over the past couple of weeks, any kind of material recession here is going to create a build in inventory, albeit short-lived until, we come out of, whatever kind of contraction there is. So just a data point. The thing that built the monster, the cherry that on top of the cake of the monster for the 10-year monster that we've had here, Dr. Frankenstein, the everything bubble, was that $9 trillion of fiscal and monetary stimulus, right? So that's gone, right? The federal government, I think, had $1 trillion surplus in terms of tax receipts. So that was a heavy drain on liquidity as cross-border, continues to pound the table on. But for all intents and purposes, it feels like the genetics of the bull market, the Tesla, Cathy, Bitcoin code that was, that drove this craziness is still alive and well on some level. We're coming out of earnings season here, which was, I think, a bit of a shock to many. And now we're already starting to see pre-announcements from the Microsofts of the world, and that's early days for that stuff. We've seen across the board unemployment, every corporation from NVIDIA all the way on down, Microsoft, say that they're slowing or stopping hiring. And we're starting to now see the first signs of cracking in the real estate market. So, and then you've seen these PMI numbers are just gruesome regionally, but we had a small uptick in the ISM. Michael's here, Kantrowitz. So just sort of, connecting the dots, the weight of the totality of all the evidence, that kind of thing. It just feels like, on one hand, this monster is still alive and well, although it's not got 10 heads anymore. Maybe it's only got 2. And, just your opinion about how this unwind should or might continue to unfold. Obviously, it doesn't look like there's a crash on the table here, but could we see a kind of lost period? Let's not call it a decade just yet, is in where, just a sort of slow deleveraging, reversion to the mean, let's call it price discovery being the goal, to be back alive and well in the world, which none of us have seen in a long time. How do you, it doesn't look like there's going to be big drama here. Could it be a thing to where, like you're saying, return free risk, but it's just kind of like a slow, quiet thing in between GDP prints and earnings? How do you see the world? Because I don't know, it just seems like it's a bit of a mixed bag here. Like all the fundamentals are pointing to, mean reversion, but you still have this goddamn monster. The fire of the monster is still burning on some level.
Yeah. So 3 aces, I agree. I think you put it very well. When you said the monster's alive and well, just I would truncate the sentence. I'd say alive. I'm not sure it's well. So the monster's been injured, and when the animal gets injured, sometimes they start to act not so nice. They get ornery and whatever. Life is not linear as much as I wish it was. It's frustrating when things don't go in a straight line, but that's life. As the great John Roque, I'll refer to it again, the counter trend rallies. Again, 2022, there were 10 counter trend rallies at 15% or more, 15 counter trend rallies at 10% or more. Trying to predict when and where is a fool's errand, but give it a couple days to the upside, and all of a sudden the bulls come out of the woodwork, and then that goes for another day or two, and then it crashes again. So I think we're in this sort of interregnum right here where the market overachieved on the downside. Let's be honest about this. I think I tweeted this out a week or two ago. Like, I didn't even think the market was going down that quickly. So it can chop and flop, and sure. And like right now, maybe it feels, and I hate feelings, like maybe we're sort of in a more placid period, but all it's going to take is something to happen, and we get a down 5% day, and I'm going to get people again reaching out to me with DMs and text messages. Can't we have a space? Can't we have a space? Everyone's beholden to the tape. And, to me, what blew me away, and I Shrub's not here, but he follows the fund flow statistics so well. You had that 20 billion inflow into equities last week. That's just mind-boggling. So the minute people think, oh, so you're saying there's a chance, can't miss that. FOMO is alive. It's not totally dead. It's alive. And so, my view is, the lessons will be presented until learned. And the positioning and the flows complicate the situation enormously. Michael Green, credit to him, he's been, pointing out the passive bid to the market, and that's certainly been the case the last couple of weeks. But prior few months didn't really help you much, and so I think the direction's down. Trying to like say, well, is it going to have 10%, 20%, 30%? How quickly? I don't know. I come back to, my rallying cry again, return free risk. It's like if you knew the direction was flat to down, expected return's negative, and whether you're going to lose, 20% in 1 month or 5% in 12 months, like, I don't know. I suspect it's more the latter than the former, but like, why would you own that? Period. And so I just think there's just so many ways to lose, and the potential downside. And you said Cantro's in here. I don't see him. He's got to come up here, and he can do it better than I can.
He changed his picture. Mike, can you please change your goddamn picture back? I couldn't find it for a week either.
Three Aces. Send him a message. Tell him to come up here. Wait. Did Cantro do a sex change thing? Is he still a guy or is he a woman now? What?
He's got that Excel spreadsheet looking green with the red on the top and the bottom.
He's trying to hide from us. I see it.
I know. I couldn't find him for a week because he changed his damn
he's trying to sneak in here. Maybe people. Cantro, you gotta come up. Come on, man. You can't do this. You can't hold out on me. So anyway.
Also, Nancy, come on up too. Meet George.
They're all hiding. I'm too embarrassed. I know. I'll be nice to you, Nancy. It's the first time. I won't bite you. Don't worry. So
George, could I reference what Three Aces asked?
Go for it. Go for it.
Yeah. So I think some of this is something that George has talked about a lot, which is price is one part, but time is a huge component of these recessionary bear markets. So even if we're entering a recession, we're very likely right at the tipping point in the U.S. at least. So I think it's important to remember. I mean, Enron didn't go bankrupt until like 8 months into that recession or 7 months into that recession. Fannie and Freddie didn't tip until 6-7 months. Lehman wasn't until 9 months into that recession. So, these things are not certain as far as when the tide's going out and things start blowing up, or do we know which ones are going to be the big ones, right? So you had Bear, you had Fannie and Freddie blow up. All these things happen, and why was it Lehman that tipped us into the acute phase of panic, right? So we've had things starting to blow up. We've had Luna, and George has been all over the Tether debacle and all that stuff. So there's all these things that are popping up that are pretty obvious. There's the Tesla debacle. I mean, there's a lot of things that we kind of already know that are, bubbling to the surface. Which one's going to be the one that incites the acute panic, the kind of tipping point of the liquidation phase of the bear market? Who knows? That's kind of a randomness part of these chaotic periods. But we've already had a pipeline of all of this stuff, all the zombie companies. I mean, it's just a matter of when.
Yeah, well, and let me just chime in one thing on that. Three Aces, on the view that the moral obligation of Mr. Market is to confound as many people as possible. The really sinister, nefarious way to screw people would kind of be what you're talking about. Like, it's too obvious to just crash the whole thing. What if we just did this chop and flop and grind? I mean, bear markets, as K-Fab was saying, time is what really kills people, right? So what if we just did this chop and flop thing? Well, there's nothing mellow. I mean, we're spitballing. Nobody knows. But I'm just going to make a scenario for you. You never get the headline grabbing, oh, this just went bankrupt type of trade, right? Instead, it's just drip, 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 down revision in earnings. Inflation doesn't go away as quickly as you want. Interest rates are flat to up. And it just grinds. And And all the momentum shit will get totally destroyed because people own that stuff for one reason and one reason only, because it's going up or later, bro. And if it loses that quality, then it ceases to be an item of interest. And so the point of it is you just get scenario paint for you in your world. Think about this. You never get the drama. You never get the breathless morons on CNBC talking about the disaster du jour. It's just this grind. It's up, it's down, it's up, it's down. Oh, it's going up. Oh, everyone pile in. So everyone buys the local high. Then it goes down. Everyone pukes the local low. And yada, 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 yada. And so, let's say the S&P's, I don't know where it is, 4,000 today. I didn't even look this morning. Let's just say, a year from now, the market's at 3,800. It's not my prediction, but I'm just making a scenario for you. Where the headline soundbite return, not that big deal. You're down 5%, big deal. Like, so what? But, in that context, in that scenario, under the hood, you get some of the same crap that we've been seeing so far. In other words, Kathy, she's 44 today. She's 25. Or maybe she's a teenager. So the real companies will actually do okay. And the Tiger Global, Kathy Wood, Chamath, garbage, all that stuff just gets continued to get eviscerated, especially as retail disappears from the market. So The market itself, who knows? Nobody knows. But I'm just saying it doesn't have to be a lights out, S&P 2500 affair. It might be something just which, is far more nuanced, but nevertheless is going to destroy people who are just on the wrong part of the playing field pursuing the liquidity-driven speculative garbage. I hope that helps.
Yeah, just one quick follow-up before you move on to the other Nancy and Michael. I'm just curious, George. 15% of the Russell 3000, 4,500 companies cannot service their debt from cash flow. Are the capital markets closed off to companies like that, or do you still think
Yeah,
they'd
no,
be able to raise money?
they're closing. I actually think that's part of the healing process. I mean, listen, Michael K will have the number. I don't have it right in front of me, but one of the Canadian Oil Mafia guys will hit me on this. We're interested here in accuracy, not precision. I think total domestic spending on oil and gas last year was $60 billion, something like that. And it was 90 or 50. Let's just say it's 60. I'm just making a number up, okay? I think total amount of money invested in Tesla call options was in the trillions. Think about that. Think about that. The whole system's turned upside down. We have to stop this insanity. This is good. This is good what's happening. Enjoy it, Three Aces. Michael K., what's up, my friend? Good to see you. And why are you so sneaky now with you change your avatar? What's going on here?
Hey, George. I didn't even know it's called an avatar, but whatever that
Well,
is.
whatever. Are you like in the witness protection program now because you're two bears? Like, why are you hiding from us?
Well, not hiding. I'm actually putting forth the framework for understanding where the hell we are and where we're going.
Go for it, man. I
And
love when you talk bear. I love when you talk bearish to me. Go for it, man.
the acronym of HOPE, which is housing, orders, profits, and employment. And this is something we threw together years ago on our team to look at, how different segments of the economy and markets react to tightening. And so, 6 months ago, everyone was freaking out about inflation and interest rates. Now people are starting to freak out about housing, even though it's been weakening for over a year. You look at the NHB index, which peaked well over a year ago, and is down 30% or so. We've seen PMIs come down, notwithstanding yesterday's ISM number. Nothing goes straight in a straight line, like you said. And now we're seeing profit warnings, and next we'll see employment warnings. So, for people that are kind of trying to figure out where we are in the cycle, where we are in the bear market, what should you be looking for to feel worse or better about the world going forward? That framework lays it out perfectly because it's the way the economy slows down and picks up 100% of the time. So it's never different. And for the reasons the economy goes up and down, it's never different. It's always tightening and easing. And we've got a hell of a lot of tightening, and it's all flowing through. So, I have no idea what the market's going to do next week or tomorrow or today or, the next 2 weeks. But yeah, I think we're in for a rough patch until we see a bottom in the economy. 19 out of the last 21 declines in the market of 10% or more took place, didn't bottom until we were within a couple of months of the bottom of the economy in PMIs. And we're nowhere near that. So
100%.
everyone's saying like
100%,
we're looking.
Michael.
We need a wipe out.
Keep
We need
going. I'm sorry.
capitulation. What does that
keep going. Keep talking.
Well, this idea that like we need a capitulation in the market and wipe out. Like, what does that mean? Like that doesn't make the economy stop getting worse. It doesn't necessarily. It doesn't make the Fed pivot. Stocks get hit. Okay, it's because they've reacted to some bad data. And if we get more bad data, you'll see more pain. But I think we're going to see, our general view is that between earnings season, we're going to see weaker economic data and weaker inflation data, and that'll support markets between earnings season. And then when we come to earnings season, we're going to see the markets roll back over because bad earnings is bad news.
Thanks, Michael. Always on point as usual. Please stay there. I'm sure we have a lot of questions. We got a lot of really good sharp cookies up here. We're going to go Bob Klein, then Nancy Davis, then Tim, and then ZAM. Hey, Bob, my friend. Good to see you. What's going on?
Hey, George. Just an observation, and love to hear your comments from everyone. Following on your point that this could very well be just a grind lower, bouncing back and forth, of course, with bear market rallies. Look at copper today, 454 up 21 cents, oil pushing higher. So if Powell's going to slow play this, as he is insistent on doing, the markets are saying, okay, fine, we're gonna keep putting upward pressure on commodity prices, and bond prices will continue to go lower, yields will continue to go higher. We grind this way back and forth in equities, and we grind this way until things crack up. That's how I see it. I think that again, they think they can just control things by slow playing it. Markets, will put it right in their face, in the sense that we'll see commodities continue up, bonds continuing lower, yields higher until this thing cracks up, kind of like 73, 74 ish scenario could very well be how this plays out.
100%, Bob. I think you're spot on. Entirely plausible. I mean, my view is, Powell can pay us now, pay us later, but one way he's going to pay us. The market will do what he refuses to, or when he wants a slow roll, as you put it. That's a good phrase. The market will do it for us. So I think you're spot on, Bob. Really like that.
George, can I ask a question on that point?
Go for it.
So I'm just curious, how do commodities hold up in this situation where the market's kind of doing the job of the Fed, whatever it may be, and the economy is definitely going to slow down, as Michael was saying? Isn't that a self-correcting mechanism for commodities to eventually pull back significantly at some point?
Bob, you want to answer that? Want me to answer that?
Yeah, no, I'll take a shot, and then you go ahead. I think that's right, but the question is, I think the commodity markets are going to probe higher until what you say happens. So until rates get high enough, or until there's enough damage done, I think commodities just keep probing higher until the Fed gets serious, or until something breaks. So I that's how I see it playing out.
I agree with that, and I think what will happen as oil continues to cycle up, it's just going to put further pressure on, and food prices cycle up. It's just going to put further pressure on real incomes, and bring forward the economic slowdown or recession. So I think the outcome is in the end is clear. That if Powell doesn't slow the economy down, and by the way, again, this arrogance, this idea that the economy is some Boeing 777 jetliner, and you just push a button here, do this, do that, and it can all be so controlled. The sheer arrogance, the hubris. I mean, there are long lead times between changes in monetary policy and changes in the economy, and it's not so simple. And so my fear is, I think a real fear is, you're just going to continue to see real incomes get increasingly pressured. You're already seeing this in the retail data. I mean, inventories are through the roof. Yeah, nominal sales are up, but real sales are down. Blah 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 blah. Either Jerome Powell can discover his Interpol Volcker, or if he doesn't, the markets will take matters in their own hands. Either way, we're going to get to the same place in the end, in my view. It's just a question of sequencing. Thanks,
George. Can I offer a dissenting voice on that?
Yeah, please.
So I think the tenor of markets shifted in mid-April towards the growth scare / recession trade.
Yes.
So that's when long-term rates peaked. If you look at relative to this discussion on commodities, if you go through the base metals, for example, they all have rolled over quite a bit since mid-April at the same time frame. So copper's rallying right now, but it's still quite a ways from what would be a high. So you look at zinc, you look at tin, you look at aluminum. I mean, you kind of go through the commodity space. So when people talk about commodities generally, and they look at the big indices, obviously the energy space tends to dominate. But if you kind of like in 2008 and these other economic slowdowns and these transition phases into recession, you usually get kind of the breadth of economically sensitive commodities start to roll over. And as I said, since mid-April, that has become pervasive outside of energy.
Right. So excellent point. I actually have a graph for that. I'll put it If anyone's interested, DM me. I will DM me with your email address, and I will send you a presentation I put together yesterday. It's got a lot of good slides in it.
Hey, kayfabe.
Can you guys hear me? Hello.
Can I just ask back on kayfabe a separate point?
No.
Okay.
Wait your turn, please. No. If there's a great graph, I've got it shows 3 different commodity indices all in the same chart. It shows ag, base metals, just what KFAB was saying. It shows ag, base metals, and energy. And energy is up and to the right big time. Ag's still drifting up. And as KFAB rightly points out, base metals sold down pretty hard. And so there's been a huge divergence there. Base metals being the most economically sensitive of the three. So it's a very interesting divergence. I don't really make anything of the move in copper today. It's just one day, whatever. I mean, but to me, the fact that oil and food have remained so firm in the face of what's really interesting, that oil and food have remained so firm in the face of increasing concerns about the global economy. To me, that's really interesting. So, all right, let's move on. Nancy, good to see you. First time.
Thanks for having me.
I'm a secret admirer. I see you on CNBC and whatever. I don't know how you put up with those knuckleheads, but we try to do long form discussions in these rooms where I actually can have a serious interaction. See a lot of we have, just so you know, this is the smartest room on Twitter, period, because I have the smartest audience. So I haven't seen you on Bubble Vision lately because I stopped watching. So glad it's the first time we actually meet. You're probably listening to all this drivel for the last hour or two. What are your thoughts, comment? Talk about whatever you want to, whatever you think's interesting right now.
Well, I'm brand new to the Twitter community. I just joined less than a month ago, so it's really awesome to be part of this call, and I appreciate you guys reaching out and the warm welcome. I've been holding out on joining Twitter for years, and I'm glad I did. I think the one thing I would just chime in with in terms of diversification and market expectations, the Fed is just starting to unwind liquidity. The quantitative tightening just started yesterday, June 1st, but the first roll off for Treasury maturities doesn't start until June 15th. And I think it's very important to look at what all the people hold in terms of fixed income, because I expect fixed income vol is going to increase as the silent hand is removed, this everyday buyer of the market. This Fed still has caps, but I'm particularly concerned about the agency MBS market. You can see it's on the New York Fed's website. I can send it around in a tweet later so you can see, but it's not the most liquid market. And the SOMA holdings, which is what the Fed has been buying in QE, they've been active saying they're not going to hold anything other than treasuries, and it's ginormous. The balance sheet is almost $9 trillion, and having that liquidity being taken out of the system at the same time as tightening policy rates and at the same time as inflation from a lot of non-demand driven sources is definitely disconcerting. So I think it's I am the portfolio manager for the IVOL ETF, which is the quadratic interest rate volatility and inflation hedge ETF. So I'm definitely a believer in owning fixed income vol as a diversifier, but any place you have mortgages, you are short fixed income volatility. And I just wanted to make that point on the call so people are aware, because just think about it. Homeowners are along the option to prepay. If you own the financial mortgage, you're short options to homeowners. It's called prepayment risk, or sometimes negative convexity, but it's a pretty dangerous time with the fragile liquidity in the markets and with this balance sheet unwind just starting.
So Nancy, that really appreciate that. So for those of us who are just like dumb equity guys and don't get in the weeds on all the inside baseball fixed income stuff, so let's consider this fixed income kindergarten, like dumb equity guys like me, right? So for an equity person, what are the most used, aside from the point you just made, in terms of just like more obvious things, like, you think long bond rates are going up? Do you think spreads are going to widen? I mean, do you have any strong views on some of these other bigger variables in fixed income land?
Yeah, I don't think it's necessarily a directional call on interest rates because I can absolutely see long dated yields going higher, but short dated yields going lower. I think Alf was talking about that with the steepening of the yield curve. The yield curve is negative, it's actually below zero. And I do think that will steepen. And I think it's kind of cool because you don't have to take a bet on the absolute level of rates. But yeah, I'd be happy, like DM me. I'm just brand new to Twitter. I have a noon meeting, so I have to jump off for that, but I'd be happy to follow up and really appreciate all the
Okay.
I've been on
All
since
right.
10,
So,
so it's been a stimulating conversation.
so Nancy, just one thing. So as it goes from the Bronx to you can't leave. No, seriously, you can leave with one condition, that we're going to have you back in this space, and you're going to be the guest speaker. So as long as we understand that, you can go.
Oh, that's awesome. Thank you. I
All
really
right.
appreciate that. Have a good day, guys.
Thanks, Nancy. Thanks. All right. Let's go to hey Tim, you had your hand up. You haven't been saying anything. Tim, did you want to say something? Tim, if you don't answer me, I'm throwing you out. You're up as a speaker, so I'm going to throw you out. Sorry, going to move you from speakers. All right. Is that okay? So let's see. Schmuck, Jackson, Three Aces, Cantro, Brian. Welcome. We got Matt Cox. We got to get you up here. I want to get the crypto update. So, Brian, welcome to state. Brian,
you got
welcome.
Alexander. You got Alexander.
Yeah, I gotta get Alexander too. So let's get Alexander up here. So we'll do Brian, and then Brian, welcome, and then Mount Cox and or Alexander. You want to come on up, put in your 2 cents. So Brian, what's up, man? Brian, please unmute yourself, Brian.
Shit, sorry about that. I didn't even know. But yeah, I don't have a question. I was just listening. I'm working at the same time. So go ahead.
Okay, so Mount Cox, my friend, good to see you. Haven't talked for a couple of weeks. A lot's been going on, and you and I spoke a week or two ago on the whole Luna nonsense and Terra. Give us the update. What's going on in the crypto world? This is from where you sit.
Oh, it's the same old insanity, basically. There's not really anything new except prices went. I mean, Bitcoin is being fraudulently held at like 30K. Like they won't let it fall. Because if they let it fall, Michael Saylor and these are like Bukele, the president of El Salvador, they're going to be in big trouble. Elon Musk, all these guys, they're not going to let it fall particularly deep. At least not Bitcoin. They're selling off these other coins, to sacrificing them to keep Bitcoin alive. But they don't even need to do that. So that's just my observation. Like everyone has been calling for, Bitcoin going very low, but it's a very fraudulent market. The structure is extremely dysfunctional and asymmetric.
Got it. So you think? I mean, I know trying to predict these things is impossible, but do you think the day is drawing near where something's going to break?
Yeah, I mean, day by day, it's getting closer to they can't keep it going.
Right.
They have no liquidity, basically. So they have to keep the Fugazi going.
And what's happening? Maybe I know in the past you've been very helpful in explaining how many coins the miners are producing, and therefore the amount of more fiat that has to come into the system to keep the price sustained. And then the hash rates, all that kind of stuff. So, could you just give me an update? Give us an update on what's going on in terms. Yeah, what does it cost you to make a coin, in the profit margin, and are the miners inclined to just sell the coins they produce, or hanging on to them? What's going on?
Yeah, so there's 900 coins being produced every day. Those coins have to be sold to pay electricity bills. That's why people call it a Ponzi scheme, because you need new money coming in to buy those coins to pay the electricity bills. So the old people who have Bitcoin already can, new money to pay old money, basically. So that's around like high 20 millions right now a day. So, and you need cash, like real US dollars coming in to pay electricity bills. And what's been happening for a long time is that the miners, there's like more than 20 of them that are publicly traded. They can always, dilute their shares, or they have been taking loans to avoid selling the coins that they mine. But that gig is slowly drying up. Like I read something the other day that they were, in critical condition on their loans.
Right. So just putting numbers on it, if there's 900 coins a day at at 30,000 round figures, let's say it's $27 million a day or $800 million a month, meaning $800 million a month of fiat has to come into the system. If they go to sell, 800 million just has to come in to sustain the price. Is that fair?
Yeah, because there's like a difficulty adjustment and stuff, so it's more or less around there.
Yeah. Okay. All right. So,
But then you have all the other coins. You have Ethereum that's also using the same. So
right.
So Ethereum, that's probably 10 million as well. So you have the whole ecosystem. It's it's bleeding heavily.
So if you look at the whole ecosystem, the amount of coins being manufactured, you'd be upwards of what, $1 billion, $1.5 billion in fiat that has to come in every month just to sustain the price, something like that. Okay. And any further thoughts on the regulatory side? I know we normally don't talk crypto in these rooms, but it's I'll allow it today because it's become a high profile item.
Sam Bankman-Fried said that he's going to spend $1 billion on the next election. So,
right.
I mean, I don't know what we're supposed to infer from that.
That's
I know
crazy.
what I infer.
That's crazy. That's crazy. Wow. Just wow. Thanks for that, Matt Cox. Always good to hear from you. Let's go to stay up there, please. Let's go to Invest 2021. Hey, what's up, Invest 2021? What do you got?
Hey, George, how you doing? Thank you for these spaces. Quick question. So what do you think of the residential real estate market? I know there's talks about REITs and whatnot, and I know residential is local, but everything went up almost together. Now, some places went up more than others, but it was almost became a national market. So I just wanted some feedback on that. A lot of people are saying it's not going to be 2008 all over again, and I can understand that, but it's just odd that prices can still stay high for this long.
Again, I'll defer to anyone else who wants to talk. And I think it's a very, I'm going to defer to Jackson. I would just say it's a very local business, and it really depends. Where I'm in Westchester County outside New York in a very affluent community, people paying cash, doesn't really matter. You go into other markets, people got to get financing. It does matter. So I just think that there's downside risk to real estate from here. But again, it varies very much so by market. So Jackson, I think you know more about this than I, Jackson.
Yeah, a lot of it's driven by the NOO, which I just tagged you and Aces in and threw it up in the nest. It's the non-owner occupied speculators. I was just in Lexington, Kentucky over the holiday weekend, and everybody you talk to says the same thing. The rich guys came in, put a little money into a place and want to do an Airbnb, but that trade is so crowded that it's drowning on its own weight because everyone did it. So there's an unlimited supply of Airbnbs at 300, 400, 500 and 300 for cleaning, etc. But again, none of that's translating to the bottom line. And these guys are getting scary. They're getting jumpy. And so the supply narrative is so distorted because of the NOO. It's 37 to 38% of all homes bought since March of 2020 are basically non-owner occupied. And that's speculation. That's more of the speculators.
Wait, Jackson, I fell out of my chair. You said since spring of 2020, last 2 years, 37% of all the homes bought are by non-owners, not non-occupied. NOO, it's non-occupied owners.
That's correct, and I'll get that data and send it over to you.
Are you kidding me? Holy shit!
I'm not,
dude.
It's all Airbnb speculative. I mean, come on.
And by the way,
put in Airbnb, and there's probably 10 to 1 what there was 2 years ago in Westchester County, etc. Everyone went into the same trade.
Jackson, just something anecdotal from my end too. I'm in here in Los Angeles. I actually have a house that I've been renting out for a while. The tenant left. I put it back on the market. I have cash flow not from the house, so it's not even an issue. I don't need it to live. I have other cash flow. I do a job. But I put it on the market, and then Airbnb came. And the person is a small person. They have several houses like that. They said we'd pay over. I looked over their financials. No way I realized they could afford this. It almost seemed like a Ponzi scheme, but I didn't care. I just needed to rent it out to have someone there to make sure it's maintained. And any second now, I feel like they won't be able to pay the rent. And they have 3 houses, and they built 3 houses like this just from subletting from other people above market, by the way.
Absolutely, 100%. NOOs till the end. It is a mess.
Jackson, you get the award of the day. I can't say I'm shocked. I just never thought about it. That just blows my mind.
It's insane.
It's a golden age of fraud. Nothing should come as a surprise.
You know what's funny too, Jackson? I was up. I had to go up to Boston last weekend. I went up to see the Celtics play, and I've never in all my years seen seen such a tight lodging market. I think there were a whole bunch of graduations going on, so it was like next to impossible to find a room. But I finally found one. But what struck me, Jackson, and you tell maybe you could add some color to this. Just in general, when you look at Airbnb now, the amount of extras, and this may be what you're talking about, they've added on to things. Like it used to be, okay, you find a room for, just pick a room. I don't know. You find a room for $200 and maybe all in it's like $250 with the taxes and the service fees and all this sort of nonsense. But now the 200 is not $250. The 200 is like $350. Where you find a room for like $100 and it would have been $130. No, it's now like $200. I mean, they've just piled on COVID fees and service charges and special prices, taxes because they like you so much. I mean, is there what's going on with Airbnb? They're under intense pressure to get their profit margins up. Like, where the hell? I mean, it's worse than Ticketmaster now. You actually look at like what the rack rate is, supposedly the list price, and then when you go to check out what you're paying, it's I got a heart attack looking at it. So can you shed some light on this, Jackson?
Yeah, absolutely. It's resort fee, COVID fee, waiter's dentist bill is on there. I mean, it's just all added in and baked in. But again, it's not translating because all those fees get dispersed. It's gotten so bad that at the top tier resorts, I talked to the bartenders, and again, you're adding 21% gratuity to all the bills. A lot of people aren't seeing that; they're double tipping, etc. But it isn't going to the team member; it's going to the company because it's got to get baked into all these different fees, etc. And then by the time the waiter or bartender gets that tip, it's nowhere near 21%. So again, those guys are starving, and the perception, and we've lowered our standards so much. I mean, that's what I keep harping about too. We've lowered our standards. We go to the steakhouse, and the first thing the waiter tells you is, it's going to be a little longer because of our kitchen staff, etc. But we're still going to pay $80 for the steak. I mean, it's just everything is a mess. But the NOO, we're going to keep harping on that, is just ridiculous. The speculators, just as Invest just said, I mean, these guys are underwater. Their tits up, and they all crowded the same trade.
Jackson, how much of that was the big boys like BlackRock?
Blackstone, if I'm not mistaken,
I'm sorry,
was like
Blackstone.
Well, yeah, no, I got what you meant there, brother. Was like 8.5 of the 37. I mean, they're also in the same boat because they crowded the trade. So you're stealing from Paul to pay for Peter. I mean, it just doesn't work at some point. You've got, 30 Airbnbs in a subdivision and nobody's living in them. I mean, it's scary shit.
And Jackson, just this is it's a new favorite subject for today. So these Airbnbs, you also see in a lot of places where towns just don't allow it. Like I was going to go to the Jersey Shore, and there's some towns you find plenty of them, and some you don't see any. And is there a lot of discrimination based on what the town's up to? Some places they're allowed, some places they're not.
We've actually fought against, with our hotels trying to keep them out of certain areas, but there's a huge black market for it, George, unfortunately. And there's, they're posted on different social media sites, etc. They might not be Airbnb, but it's, Jimmy's Rental or something along those lines. So they're still getting it, but it's getting too expensive. The consumer's finally starting to say no.
Right.
They can get around that too, by the way, George. Just as you know, it's most places the short term it's like 30 or something days, and they could just list it on the website for 30 days, and then someone calls them and says, "Hey, I need it for 2 weeks," and they work around it like that. I've seen that happen here in LA a lot.
I remember a couple summers ago I went to Atlantic City, believe it or not doing that again, and they were telling Atlantic City, which is totally screwed up. And Jackson, maybe you got a sight line on that, given all what's going on with the casinos and everything, but there. The city council, which is controlled by the business interests, obviously, they just implemented. They put in. This is like 2 summers ago. They passed some crazy tax, some usurious tax, which like all the Airbnb people had to pay. It was basically the hotel lobby saying, going to war with Airbnb people and with the individuals. And so there was going to be some outrageous tax. I forget how much it was that they were going to put on all these rentals. So I don't know. It seems to be very political item. I mean, Jackson, what's your experience? Is the patterns pretty disparate across municipalities? I mean, is it vary a lot from place to place?
I think it's all falling in the same line now. In the beginning, a couple years ago, 3-4 years ago, like you're talking about, it was more regional. I think now it's so extreme. It really is. It's disturbing.
Wow. All right. Any other questions? Otherwise, I think we're going to shut this room down. We've been at it for 2 hours and 10 minutes. This has been an awesome room, as always. Alfie was great, and I love the pace of the room. So many smart people. I just love coming to this room and learning from all you folks. This is awesome. I'm going to be away for a week, but maybe I'll do a room from wherever I am. We'll see. Meantime, just, do your homework. There are no quick fixes. This is a marathon, not a race. And thank all you guys. And
You wouldn't be going to San Francisco, would you, George?
Why would I go there? Oh, no. Okay. Oh, yeah, I forgot. No, so I'm actually going out of the country. I'm hoping to, if anyone wants to meet me on June 16 in Boston, if there's a game 6, I'll be there. But next week I'm away. So, but no, but Cape Town, who's going to win? You got any view on the series?
I think it's a tough one. I think it's like one of those coin flippers.
Yeah, I agree. There'll probably be something we can't foresee, like an injury or something like that, that's going to tilt the scales. Who knows? All right, everyone. This has been awesome. Thanks, guys. See you again before too long. Take care. Bye-bye.